On the morning of August 17, 1998, the Russian state did not simply disappoint investors. It broke the basic contract of the new system. You wake up in a country that has spent years telling you that the Soviet world is over, that markets are modern, that banks are real, that government debt is the safe foundation beneath everything else. By afternoon, that foundation is gone. The state says it will restructure its domestic debt. The ruble's trading band is blown wider. Banks are shielded by a 90-day moratorium on key obligations. Within days, savers discover the practical meaning of that language. Cash becomes difficult to reach. Dollar prices jump. Contracts stop meaning what they meant last week. And the number in your account is no longer the same thing as money. This is the part most retellings flatten into a generic, emerging market crisis. It was not generic. It was a triple fracture. Sovereign paper failed. The currency failed. The banking perimeter failed. And when those three break together, the middle class does not lose abstract wealth. It loses time, optionality, and trust all at once. The official story was that Russia had been hit by external pressure, Asian contagion, bad luck, low commodity prices. All of that was true, but incomplete. The forensic truth is harsher. Long before the announcement, the system had begun paying insane prices just to postpone recognition. In late May 1998, rates were pushed to 150% to defend the currency and keep buyers inside the state debt machine. That is not stabilization. That is a distress signal dressed up as yield, and that is the real question at the center of this story. If a government bond is paying 150%, are they paying you for your capital, or are they paying you for your blindness? Because by the time ordinary savers were still hearing words like support reform and IMF package, smarter money was already asking a different question. Not how much can I earn here, but how fast can I leave before the exit becomes administrative, legal, and irreversible? The trap did not begin on August 17th. It began the moment the Russian state started financing a weak tax base, a fragile banking system, and a political transition with debt that had to be rolled over every few months. These were the GKO bonds, short-term domestic treasury bills sold as proof that post-Soviet Russia was becoming a normal market economy. On paper, they looked modern. Auctioned, tradable, increasingly integrated into global capital flows. In practice, they became something much closer to a refinancing treadmill. The state was not borrowing long and building durable credibility. It was borrowing short, then borrowing again to pay off what had just matured, hoping confidence would survive one more auction. That structure matters because short-term debt does not forgive hesitation. A government with long maturities can absorb fear for a while. A government with debt constantly coming due has to return to the market again and again, asking the same question in different words. Will you still fund me next week? And to keep hearing yes, Russia had to offer yields that stopped signaling safety and started signaling desperation. This is where many retail investors and many citizens read the picture backwards. They saw high yields and assumed opportunity. They thought the state was rewarding patience, but extreme yields in sovereign debt are not a gift. They are the price a borrower pays when trust has already begun to fail. By 1998, that price became grotesque. Rates were driven upward not because the system was healthy, but because it was cornered. The government needed fresh buyers. Banks needed the trade to continue. Speculators saw a way to earn huge nominal returns as long as the music kept playing. Everyone inside the machine was incentivized to pretend rollover risk was temporary, but the logic was circular. Higher yields made the debt more expensive to sustain. More expensive debt increased default fear. Default fear demanded even higher yields. That is not investment. That is a pyramid built out of refinancing. And like every pyramid, it survives only while new money arrives before old promises come due. The most important forensic point is this. Once a state begins paying triple-digit annualized yields to keep domestic debt functioning, the bond market is no longer a place where information is being calmly priced. It is a panic meter with formal paperwork around it. The coupon stops telling you what you will earn. It starts telling you how urgent the funding hole has become. So when people say the default came suddenly, they are confusing the announcement with the mechanism. The announcement was sudden. The warning was not. The warning was visible every time the state had to pay more for one more week of borrowed belief. A debt pyramid can survive longer than logic says it should, but only if the state still has cash coming in. That was the second break beneath Russia in 1998. The debt machine was fragile on its own, but it became lethal when the country's external earnings and fiscal intake started to weaken at the same time. Russia was not a diversified, resilient tax state. It depended heavily on commodities, especially oil and metals. And when global prices fell after the Asian crisis, the damage was not confined to export statistics. It moved straight into the government's bloodstream. Foreign exchange grew scarcer. Tax collection weakened. The state's ability to defend the ruble and refinance short-term debt began to erode together. This is the part audiences often miss because oil prices fell. Sounds too clean, too technical, too remote from daily life. But the lived mechanism is brutal. When a commodity state loses price support, it does not merely earn less. It collects less. It delays more. It improvises. Wages arrive late. Pensions come late. Regional governments stop trusting federal promises. Enterprises lean harder on barter, offsets, and mutual non-payment. Normal commerce begins to acquire the texture of emergency administration. The financial crisis appears on television only later. On the street, it begins as delay, substitution, and the slow disappearance of certainty. And while revenues were thinning out, the state was still trying to maintain the ruble inside a narrow exchange rate band. That choice mattered. A managed currency can project calm, but defending it burns reserves precisely when reserves are most needed. Russia's authorities were not just funding the budget, they were funding the appearance of stability. The more money that left, the more dollars the central bank had to spend buying rubles. The more it spent, the more investors understood the defense was finite. What looked like policy credibility became a countdown clock. So now the country had two clocks running at once. One was the debt maturity clock. How many days until the next wall of obligations had to be rolled over? The other was the reserve clock. How many dollars remained before the currency defense stopped being believable? That is when the whole episode stops looking like a normal sovereign funding problem and starts looking like a timing game. Because once the market sees that both clocks are running down together, the question is no longer whether the state is solvent in theory. The question becomes whether you can exit before everyone else realizes the same thing. By July 1998, the official narrative had one last asset left: outside validation. The IMF approved a support package worth $6 billion, presented alongside help from the World Bank and Japan, and for a brief moment it did exactly what these packages are designed to do. It did not repair the structure, it repaired sentiment. It gave newspapers, bankers, and ordinary investors a sentence they could repeat to themselves: the international system will not let Russia fail this way. This is why bailout money is so often misunderstood. People imagine it as rescue capital descending into a broken country to restore order. In reality, in late-stage crises, it often functions first as narrative capital. It buys time. It extends the interval in which insiders can distinguish between reassurance and repair. And that distinction is everything, because the IMF package did not solve the central problem. It did not turn a short-term refinancing machine into a stable funding structure. It did not rebuild tax collection overnight. It did not permanently raise oil prices. It did not remove the contradiction between defending the ruble and preserving reserves. It simply created a final window in which public confidence could remain higher than the underlying cash flow reality justified. For retail investors, that kind of window is dangerous. They hear international backing and infer safety. They assume due diligence has been done somewhere above their pay grade. They treat external endorsement as proof that the worst-case scenario has been taken off the table. But the forensic record says something colder. When a system requires outside reassurance to keep domestic debt markets functioning, the reassurance itself becomes part of the trap because it changes behavior. It keeps depositors in place a little longer. It keeps local institutions carrying risky paper. It delays the psychological break that might otherwise force an earlier exit. And in that delay, the better connected actors do not relax. They use the time. That is the hidden cruelty of the final stabilization phase. Public language gets softer, while private behavior gets harder. Officially, the situation is being managed. Unofficially, balance sheets are being shortened, exposures reduced, dollars sourced, counterparties reassessed. Then August 17 arrives, and the state stops pretending it can separate the debt problem from the currency problem or the banking problem. The package announced that day was not one measure. It was a combined admission. Russia would restructure its domestic ruble debt. The ruble trading band would be widened, clearing the way for devaluation. And a 90-day moratorium will protect banks from immediate obligations tied to parts of the external and derivatives market, helping freeze the system in place long enough for losses to spread outward. That is when ordinary people learn the difference between reassurance and escape. One is what keeps you calm. The other is what gets you out. Now we reach the most emotionally charged part of the story, and also the part that requires the most discipline. History does not need to prove that every oligarch got a phone call on August 16th to establish betrayal. The forensic record is already damning enough. What matters is that access was unequal, timing was unequal, and the people closest to the machinery were far better positioned to convert paper claims into usable protection before the freeze spread through the system. By the summer of 1998, capital flight was already accelerating. One widely cited case study estimates that roughly $4 billion left Russia between May and August 1998. That does not prove a single coordinated conspiracy. It proves something more structurally important. Money with mobility was leaving while official reassurance was still being broadcast to everyone else. And inside the banking sector, the behavior becomes even more revealing. Studies of the post-crisis rescue note that before the GKO default, most commercial banks had significantly reduced their GKO portfolios and shifted proceeds into US dollar reserves. By the time the market finally broke on August 17, many of the largest institutions were no longer positioned the way a trusting depositor would assume. In other words, the public was still holding faith in the system while the system's own professionals were shortening exposure and sourcing harder money. That is the real meaning of insider exit. It is not always a dramatic midnight transfer with a signed confession attached. Sometimes it is quieter than that. Balance sheets get cleaner. Short-term state paper gets sold. Foreign currency buffers increase. Offshore channels matter more. Legal entities with connections buy time that households do not have. The elite does not need omniscience. It only needs better visibility and faster access than the public. And once the announcement lands, that access gap turns into a social wound. Because an ordinary depositor cannot liquidate uncertainty the way a connected institution can. A citizen with wages in rubles and savings inside a local bank cannot rotate into safety on command. They discover too late that their wealth was nominal, conditional, and trapped inside a failing perimeter. The people who adapted first were not necessarily the smartest in any moral sense. They were the people closest to information, convertibility, and legal insulation. So this is the pattern to remember. When official calm remains loud, but sophisticated domestic players are quietly moving from high-yield sovereign paper into dollars, offshore structures, and shorter exposures, the message is not confidence. The message is evacuation. The useful lesson from Russia in 1998 is not always expect betrayal. That is too vague to protect anyone. The useful lesson is that liquidity fails in layers, and official reassurance usually lasts longer than access does. First, the state pays abnormal yields to keep refinancing alive. Then outside support arrives and creates a final burst of confidence without fixing the cash flow hole. Then the people closest to the system reduce duration, increase dollar exposure, and shorten promises. Only after that does the public, receive the full language of emergency. In Russia, the sequence was visible. The GKO machine strained under extreme rates. The IMF-led package of July 1998 bought time, but not resolution, and on August 17th, the government and central bank combined debt restructuring, devaluation, and a 90-day moratorium on parts of bank obligations into one admission that the perimeter could not hold. So the defense is not ideological. It is procedural. Watch domestic sovereign yields for distress, not income. When a state must pay absurdly high short-term rates, the market is telling you that rollover risk is becoming political. Treat bailout headlines as a question, not a comfort. Did they repair the funding mechanism or merely extend the narrative? And never confuse a bank balance with immediate purchasing power. In crises, usable money is money you can actually reach. A modest reserve of physical cash outside the banking perimeter is not paranoia. It is recognition that settlement systems can fail before accounting systems admit they have failed. The same record also suggests another signal. When banks and connected capital are rotating away from domestic paper and toward dollars, they are not voting for stability. They are voting for exit. That does not mean every high-yield market ends in confiscation. It does mean the burden of proof should reverse. When a system starts paying you extraordinary returns to remain still, your first duty is not to calculate upside. It is to ask what they know about the door. Because in every paper regime under stress, there comes a moment when wealth splits in two categories: what exists on statements and what still works on Monday morning.